we are just planning for finishing of this advanced capital budgeting. So we will have FR anytime in the next week, coming week. One of these days in the evening, we can just have it done. So today we thought we will finish off advanced capital budgeting. Yes. See, we have just done some basics of capital budgeting. So now let me just run through that. So in case you have missed out, I thought I will help you out. See, the basics are like this way. Tools of capital budgeting, where you have classification of the tool into two as non-DCF and DCF. In non-DCF, you have payback and average rate of return or accounting rate of return. Then under DCF, the first one is NPV, IRR, profitability index, equated annual cost or equated annual benefit, and lastly, discounted payback. See, unless otherwise stated, we are not expected to use IRR, EAC, there is discounted payback, ARR, and PB. See, out of 7, 1, 2, 3, and 4. 4, we cannot use unless it is stated in the problem. So therefore, if the problem is silent regarding what tool you are expected to use, so that is what I'm trying to say is that this 4 out of 7 should be used only when it is asked. When the problem is silent regarding what tool you got to use, then it is 3 by 7 only. What are the items that you can take it up? So it is NPV, profitability index, EAC, AB. So when to use and all that, we have made a discussion in the earlier classes. Okay. Now, what is it we are trying to do for this weekend? So we had a lot of doubts people are asking. So let me just check up. Illustration number 1, is that over? So we will finish off all that we have. So if there were to be anybody who had just closely followed our classes, could you just tell me as illustration number 1 got over? Vanessa, are you following? And Venkatraj,
Yes,
are you following?
illustration 1 and 2 are over.
1 and 2 got over. Okay. Right. Illustration number 3, we will take it up. So, capital budgeting, advanced capital budgeting would mean we have in it very importantly usage of statistical tools. Usage of statistical tools in evaluating the project. So, under that, we do classify items in this fashion. What are the tools that are available? Now, let us just take up. First one is risk adjusted discount approach, which you call it out as RAD. I will explain. So, firstly, I will note down risk adjusted discount rate. Certainty equivalent approach. Equivalent approach. EEA. Okay. Then coefficient of variation approach. Coefficient of variation approach. Coefficient of variation approach. Variation approach. Then we have what you can call it out as scenario analysis. Then we have simulation. Then we have cause and effect. What you can call it out as on the other day we have just taken up um, cause and effect. What is the name through which we have called cause and effect study? We have done that. If we change cash flow, if you change cost of capital, what
Sir,
is
is
it?
it sensitivity?
Yeah, I was just only expecting you people to take it up. Sensitivity analysis. Then next one, real options. So first and foremost thing, let me just take up on to risk-adjusted discount approach. What is it we are expected to do in the case of risk-adjusted discount approach? Now let me just take up. So just watch out. Capital budgeting, risk and uncertainty, right? If the acceptance of an investment proposal or a group of proposal alters the business risk complexion of the firm, the investor and the creditor are likely to view the company differently before and after the acceptance of the proposal. See, what do you mean by that? You just find when a company is taking up a riskier project, then the company itself will be evaluated in the minds of the investors very differently from what they were doing it before. Imagine that our company is just taking up very safe projects like taking up education, taking up hospitality industry, and taking up service industry like that way. When our portfolios are only into these safe areas, when we are trying out something like movie making, so quite naturally, it is not that project alone they take into consideration. They take into consideration the overall risk associated with the company. So then people, when they are providing money, definitely they will be expecting very high returns because risk associated with the project is on the higher side. So please keep that in mute mode. Please keep that in mute mode. Right. Next one, consequently, the total valuation of the enterprise may change. The greater increase in perceived risk, lower the valuation, all other things being equal and vice versa. Quite naturally. That is what I was just telling. If you are trying to accommodate riskier projects, then the overall valuation of the company will undergo a change. In evaluating the investment proposal, a firm should take into account the effect that their acceptance will have on its perceived risk. So whenever we accommodate certain things, see, naturally the credibility of the entity will go up or come down depending upon what project you are accepting. Right? Decision making and capital budgeting. So now the person will definitely be asking or will be telling that it is very complex for him to take decisions. Okay. Now, decision making in capital budgeting. We have under uncertainty and we have under probability of occurrence. That is decision under certainty, decisions under uncertainty, and then involving risk. So here, when you have under certainty or certainty, probability of occurrence is known 100%. How it could be 100% probability? See, I have just taken up a project of real estate. I have entered into a contract with a tenant. See, it so happened yeah, one of our clients are just about to buy a commercial building. I was just he was asking whether it can be profitable. We have made a due diligence. So I was just asking where is the tenant. He said the previous owner is assigning the tenant to me, so there is no need for me to search for new client, and already the existing clients will be continuing with us, and is what he was just telling. So quite naturally, the agreement that they have entered regarding the lease rental and all that were all fixed, and the chances that they will back out is also very bleak. So they will continue to be there, and rental is likely to be a certain income. I'm just giving an example. That is not the only item that you can take it up. Next one is probability of occurrence is not known when you have under uncertainty. Then the next one involving risk, probability of occurrence is estimated at some percentage. Here, probability itself is not known, but you can estimate to a very great extent. Some percentage would mean the occurrence may be 10% or an 80% or 50% or 40% based on some research work and based on the past happening. So tools that are used are risk adjusted discount approach. Now, first one we are taking up risk adjusted discount approach. What is that? You have it in this particular place. Classify cash flows as certain and uncertain. You classify them. Even in the project itself, it is not that all the cash flows will be uncertain. So have that in your mind that there will always be a combination of certain and uncertain. What is that you can consider as certain and what is that you consider as uncertain? Can you just tell me? Can you give an example? Anybody can just participate. Please just do that. In a capital budgeting, what is that you consider the cash flow as certain and what is that you consider that as uncertain? See, the cash outflow is certain. The cost of the project that you are taking up because spending is done now, it is not in the future. So naturally, it is going to be certain. Similarly, the supplier of the machinery is bringing you a guarantee saying that he will take the machine back 4 years later at a particular price, which is also certain because he is promising. Similarly, the working capital that you are spending is a certain amount of cash outflow, and you realize that amount at the end of the project time, that is also cash inflow. So these are the certain items that you have, and rest of the items like what could be the revenue, what could be the cost, the expenses, how much is the taxation that you pay, how much is the tax saving that you make on depreciation, all these are uncertain. So when you classify the cash flow as certain and uncertain, naturally you need to have two sets of costs of capital. One, for certain cash flow, you have got to use different cost of capital. For uncertain cash flow, you got to use a higher cost of capital because of the risk associated with the uncertainty involved in the cash flow. Certain cash flows are to be discounted by ordinary cost of capital. Uncertain cash flows are to be discounted at higher, that being adjusted cash cost of capital. Are you clear? Then accept the project in case of positive NPV and reject in the case of negative NPV. Very simple. Are you understanding, all of you? So there is a need for you to classify the cash flow into two as certain and uncertain. Certain cash flows are to be discounted by ordinary cost of capital. Uncertain cash flows are to be discounted by higher cost of capital. So why higher cost of capital? Because of the uncertainty associated with that. Is that okay? The next item is certainty equivalent approach. What do you mean by certainty equivalent approach? So when the cash flows are uncertain, then you are expected to use higher cost of capital. That is understandable. So we can't be complaining that things are uncertain. So therefore, I'm using higher cost of capital. So what is that you can do? What is the betterment that you can bring out? The betterment is where you closely follow, where you bring out certain cash flow. So no meaning in saying that the cash flows are uncertain and keep adding a higher cost of capital and do that exercise. Rather, you keep that exercise on where you tell that I am bringing out certain cash flows. So therefore, we will be introducing a new term called as certainty equivalent points, CE. So how these certainty equivalent points are arrived at? So quite naturally, there will always be a science behind as what is the extent of the certainty associated with the cash flows. So now let us just take up that certainty equivalent points are to be multiplied by each of the cash flow. That means there will always be a research that people would be making. So even when the results are likely to come, see, I will put it like this way. All of you, please closely follow. This is not related to capital budgeting, but I am taking up things what I have just seen in the case of some of the interviews made by some astrologers. See, not that I am interested in astrology, but astrologers have communicated this way. Those who are considered to be underdogs, those who are not very prominent, the periods that you have in the future, they will become prominent. People who are in prominence, they will automatically lose their positions because naturally there will always be a new things which will be coming up, and people have just predicted that not so greatly or not so popular parties might fare well is what these astrologers have communicated. See, astrologers may not really know as where these things will affect. Now, I've just seen Australia versus West Indies match. I've considered that as the best. That is better than India versus England. Not that I'm not patriotic and all that. So the way in which the West Indians are playing was something very great, very great. I do not know how many of you could just follow. Today, West Indies had won the match, and with not so famous bowler, I've just got 7 wickets. And the pace at which he was just bowling, I could just see that West Indies got back their olden days. So there is Shamar Joseph, and he bowled with full pace. And I just witnessed the highlights. So superb. And I just sent it to my son, to other friends. Please just watch. He's a good man to account for. And other batsmen are all, without any fear, they are all playing Australians. They won by 8 runs, just by 8 runs. First innings lead they had. So why should I tell you about this? Always remember, there will always be some astrologers who are just telling about some events that are likely to happen. So they were talking something about not so great parties will become prominent because a astrologer may not be really telling you whether the person will be studying UG or PG. He will be telling that higher studies. Whereas people who are going for taking up astrological advice, they want micro details. Micro details they will not be in a position to tell. Right? They will tell that he is going to have higher studies. It could be PG or it could be UG also. They can tell only that way. Macro predictions they can just bring about. This is what generally people just carry out because in television you just find people telling that not so prominent people will become prominent. It is happening. West Indies is at the top. I do not know about what is happening between India and England. I feel that England will win. I feel India will lose because in India there is a problem that they have. What is the problem they have? They don't want Ashwin to get as many overs as possible. They are trying to bring in um, give a lot of overs to Jadeja and Akshar Patel and try to give less opportunity to Ashwin. I am not in favor of Ashwin or something like that. I want Indians to win, but that is not happening. This sort of problems that you people will be finding. Likewise, there will always be a scientific study as how much is the certainty associated with the cash flow. Definitely that certainty equivalent points with which the cash flow should be multiplied. Once the certainty equivalent point, which will be say zero point 0.4, 0.8, 0.7. What do you mean by that 0.8, 0.7? That is 70% that it is likely to happen 100%. So an uncertain cash flow, when it is associated with certainty equivalent points, automatically it partakes a characteristic feature of certainty cash flow. That means the risk associated with the cash flow is totally eliminated. Now it has become risk-free cash flow. Therefore, what is that we should do? Such cash flows should not be discounted by ordinary cost of capital. It should even be discounted at risk-free cost of capital. That is the point that you got to remember. The products of cash flow and certainty equivalent points shall be riskless cash flow. Such risk eliminated cash flow shall be discounted by Risk-free cost of capital. These are all very, very important points. Have that in mind. Accept the project in case of positive NPV and reject in the case of negative NPV. This last point is going to be common wherever NPV is used. Is that clear? Are you having any doubt in this particular case? Please just understand that these are all very, very important points. Shall we proceed?
Yes, sir.
Yes, sir.
So, probabilistic distribution. What is this probabilistic distribution? Say, normal distribution is more appropriate in this case where I go to tell something about standard deviation or compute standard deviation. I'll be talking something about variance, means, etc. So, the lot of statistical tools will be coming into play. Probabilistic distribution. Okay. So, you call that as mean cash flow. What do you mean by mean cash flow? What do you mean by standard deviation? All that we have studied at our higher secondary level. So, now we are going to pull all that, our higher secondary or foundation level things we got to learn. NPV and a coefficient of variation. This is what I have just written, COV and normal distribution. So now let us just take up some illustrative example as what we are going to do. So I would like you people to take a screenshot of this. If you have just done that, please let me know. We will proceed and bring out our analysis on this. Have you made notes? Please just tell yes or no.
Yes, sir.
Right. You have just done that. No. So now I will be using Excel sheet. So one of you please help me out in bringing out. Otherwise, I got to change screen from one place to another place. Right. Right. So in the first year itself, I have different year number 1. What are the cash flows? Can you just tell me what are the cash flows that you have for year number 1?
6,000,
Right.
10,000,
Hmm.
14,000.
14,000. Probability?
0.3, 0.4, 0.3.
So it is expected cash flow. See, whenever a cash
So
flow is multiplied.
the second probability is 0.4.
Right. I got it. Thank you. See now, whenever a cash flow or any number which is multiplied by probability when you are getting a product and some of the product will be taken up as expected value. Here the cash flow is multiplied by probability. You call that as expected cash flow. 6,000 into 0.3. So 10,000 cash flow for year number 1. Year number 2. Sorry. Year number 2 is this. Yeah. Tell me what are the cash flows?
4,000, 8,000, 12,000.
Probability?
0.2, 0.6, 0.2.
Then year 3.
6,000, 10,000, 14,000.
6,000.
10,000,
Hmm.
14,000.
Probability?
0.3, 0.4, 0.3.
Correct. Now, what we do normally is that year number 1, 2, 3, we take the cash flow as 10,000. We take this as 8,000. We take this as 10,000. And we arrive at what was the PV factor that we have seen there? 6%. Discounted cash flow. So discounted cash flow 20,000 and your NPV is going to be 4,950. Is that okay? Are you clear?
Yes, sir.
All of you, are you clear? So what are the questions that you have? The question is that what is the mean cash flow and what is the standard deviation? Correct? How do you arrive at the standard deviation? So please understand, this is mean cash flow for each year we have got. Mean cash flow for each year, we have got it as 10,000, 8,000 and 10,000. Correct? We have answered to second question, mean of the project. Mean of the project is nothing but NPV. But we have not yet answered, that is handled, what is the standard deviation of each year's and standard deviation of the project. We have got to arrive at. Now, let us just arrive at the standard deviation. Standard deviation for each of the years. Year number 1. How do we arrive at? Any idea about us how we can promote this? Any idea? Say now, instead of doing like that, I would like to take up variance. So how do we arrive at? Probability into individual cash flow minus mean cash flow to the power 2. Correct? All of you, are you understanding? If you say yes, I will proceed. Otherwise, whatever doubts that you have,
Yes,
you can
sir.
just, are you clear? Individual years cash flow, that is individual element of cash flow is compared with the mean cash flow of that particular year. This is variance and standard deviation is going to be square root of the above. 3098.39 is the standard deviation for year number 1. Correct? Is that right? Now let us just arrive at the variance. Now tell me as what is that we should do? Equal to probability into the cash flow that they have. I think we have just not done it proper. Hmm. One moment. I will just do it right. Now tell me as what is that we should do? Probability multiplied by the cash flow minus the mean cash flow of that year to the power 2. So our standard deviation for year number 2 will be 2529.82. Correct? Are you understanding? All of you say yes or no?
Yes, sir.
If you have any difficult moments, please let me know. I am just there waiting for your clarity purposes for which I will go slow. Please just don't worry about that. Variance. Tell me what is that we should do? Equal to probability into the cash flow minus the mean cash flow dollar sign to the power 2. Correct? So we are bringing out the standard deviation for the project. Standard deviation of the project. All of you, are you noting down? Are you making note of as how computation is carried out? So I am having this Excel as a tool to quicken the process of getting the answer, but for clarity purposes, it is always good that you work out. Now, let us just take up year number 1, 2, and 3. Right. Now, I have standard deviation. We are picking this standard deviation from the respective positions, and I am taking up PV factor as variance I should do. How do we arrive at the variance? Any idea? Now, I will multiply the standard deviation into the PV factor and I will take a square of that. So standard deviation of the project is going to be like how we have just got it. Same is the way we will be getting. How did you arrive at? 3098 multiplied by 0.9434, the whole power 2. That is the way we will be arriving at. Is that clear, all of you? So we have answered to mean cash flow for each year and standard deviation. Got it? You need to say yes or no.
Yes.
Mean and standard deviation of the project. Got it? Mean of the project, mean cash flow of the project is nothing but NPV. Standard deviation, we have got it. Now, what is coefficient of variation? Now I am going to give you the formula. Are you clear? Coefficient variation is equal to standard deviation divided by mean into 100. Greater the percentage, greater the percentage, less will be the reliability. Standard deviation is 45 15 divided by 4950. That is 91 percentage is what you just get. Are you clear? All of you, are you clear?
Yes, sir.
Yes, sir.
Then comes find out the probability that the project will be greater than 6,000. Normal distribution as how we carry out is like this way. Number one, when they ask for probability, then it stems from three different steps. Step number one, step number two, and step number three. Step number one, z is equal to x minus x bar divided by standard deviation. Then normal table value of z. Normal table value of z. And the probability is equal to 0.5 plus normal table value of z when z is positive. Probability is equal to 0.5 minus normal table value of z is negative. So z is positive or negative. Normal table value will be on absolute value. On absolute value. You have to find out for absolute value. Now, what is x bar? X bar is nothing but NPV. This is for standard deviation. Right. Now, step number one. What has happened to England, India? In India, there is England at 1. So here they have mentioned that what is the probability that it will be greater than 6,000. Always remember that it is bell-shaped. This normal distribution is bell-shaped. Okay. So here it is the middle value. This is 0.5. That is resulting for your NPV that you got it. NPV is 4950. So please understand that they are asking about a number that being 6,000, which is greater than 4,950, which will be on the right hand side. Now, the question is that find out the probability that the project, sorry, find out the probability that the project will end up with NPV greater than 6,000. So they are asking about this being the probability. How do we arrive at this probability is that we can arrive at this probability completely 1 minus this okay. So our answer will be for this portion. Say, let us assume that if that comes to 80%, probability that it will be greater than 6,000 is going to be 20%. So always remember, we will arrive at a general solution, but depending upon the scenario, we have got to undergo or take that change. So I will put it this way, probability that it is going to be 6,000 or less than 6,000. See, all of you please remember, see this normal table value cumulative and all that is a normal day-to-day happening, but people do not capture things in their life. Okay, now I am the audit manager of one of the big audit firms. Okay, I am asking you, all of you, to assemble at our office at about 7:30 a.m. 7:30 a.m. you should be there. We will go for physical verification of stock. Okay. So that means a person who had just come by 7:12, is he obedient or not obedient or disobedient? Whether he is obedient or disobedient. Come on. I have asked them to come by 7:30. Coming by 7:12, is it obedient or disobedient? All of you?
Obedient.
Obedient only. Can I just say, I have asked you to come by 7:30. How dare you come by 7:12? See, that question itself is a wrong question. No. So you know that. So if it were to be 6,000, anything less than or equal to 6,000, we will always be taking it upon cumulative basis. So you should not be asking a question, sir, where is that less than 6,000 we will take into consideration. I am just giving you an example. I am the audit manager asking you to come by 7:30, a person come by 7:15. I will take him as he had come by 7:30 only. Are you understanding? So you always do it on cumulative basis. Always this is the case. Right? Have that mind. Okay. So when they have said 6,000, anything less than or equal to 6,000 for which probability will be arrived at. Probability will be arrived at only for the range. And this being 4,950 divided by 4515. 4515. So can one of you, I'm not just having calculator nor my mobile, I put them into charge. Please help me out. 1050 divided by 4515. Please get me the number.
So 1.
Or
0.23, sir.
0.23. Step number 2. Normal table value of 0.23. This is positive. No problem. But positive or negative, you have to arrive at normal table value of absolute 0.23. So go to normal table value. Now I will try finding out normal table. So we have in the last page normal table value 0.23. 0.23 comes as 0.0910. Is that right? So this is the one that we are arriving at. 0.2 and 0.03, 0.0910. Is that right?
Yes.
Step number 3. Probability is equal to 0.5 plus 0.0910, which is equal to 0.59. So you should understand that probability that it will be 6,000 or less than 6,000 is going to be 59%. What is the probability that it will be greater than 6,000? 41%. Is that right? Answer to this particular question is 41%. Are you understanding? Say yes or no.
Yes, sir.
We have answered to
Sir,
all the questions there. Yes.
sir, 59% you arrive no, sir.
Hmm.
1 minus of that is only the probability of that.
Correct.
Can you
Correct.
explain that, sir? 59, 41% again.
Say, the universe is always 100%, no?
Correct, sir.
If 59% of the occurrence where it will be 6,000 or less than 6,000 would mean the remaining 41% is it will be greater than 6,000. Simple
Okay,
as
sir.
that, no?
Okay, sir.
That's it. Are you clear? All of you?
Yes.
Right. Now, sir, you've just done all this in the form of Excel. So people might even be asking the question, sir, I'm not very familiar with all this computation, sir. You have just done, I'm just copying. Okay, I understand that is the sort of feeling anybody will have when you have lost touch with the subject for a very long time. So some senior is telling this is the template, please use it. Is there any way through which I can cross verify? Yes, we can cross verify, no problem at all. So in the first year, it could be 6,000. In the second year, it could be 8,000. In the third year, it could be 14,000. It could be happening in any ways. Correct? Any combination of ways you can arrive at. Are you understanding what I'm telling? So how many different ways through which the cash flows can be developed? So 3 cash flows here, 3 cash flows here, and 3 cash flows here. How you can arrive at? How many combinations in which it can take place, take shape? Come on, come on, come on. And I got to use probability of all this to develop that work for that many combination. We don't have time under examination conditions. So accept this is right. For a smaller problem, I will demonstrate. Please just don't worry about that. Okay. So this is correct. Now this is what we have just done. 4950 standard deviation as how we have just got 3098, 2530. Remember 2530. Here we have taken up that. Then 3098 and 4514. Right. Whatever we are just doing, let me tell you, it is all very simple. If your basics of your mathematics and statistics in the early stages are very strong, you will not have any problem at all. If you have forgotten also, no problem. You can regain it, no problem at all. Now let us just come to that coefficient of variation, which is equal to standard deviation divided by mean into 191% we have got. It indicates the dispersion of actual cash flows away from the mean. What is the chances that your actual happening is likely to be far away from the mean? When the percentages are higher, that means the chances that the fluctuation is going to be wide. Higher the percentage, higher will be the variation, higher will be the swing. Greater the dispersion, higher is the involvement of risk, and vice versa is true. What do you mean by that? When the percentages are considered to be very, very less, very much minimal, that means the actual cash flow will be closer to the mean. The risk level will be less. Higher RAD shall be assigned for projects having higher coefficient of variation, and vice versa is also true. Very, very important matter. Please be careful. Next one. Mean of the project is nothing but NPV of the project. Do you agree with me? Just now we have just completed coefficient of variation 91.2. Correct. Normal distribution, step 1, 2, and 3. Probability that it is going to be is 59.1. So 41%. We have got it like that. Diagrammatic presentation, we have already done that. So this was there in the very, very old syllabus. Are you clear? All of you, are you clear about this?
Yes, sir.
Simulation. Simulation, Monte Carlo simulation. So where you assume certain things and work out. That's not a very difficult one. through simulating a real-time situation with the help of random numbers, the project managers can draw conclusion, elevates himself in a better decision-making process. So where simulation will come, the place where mathematical models fail, statistical model will come into place. It is a scenario of something is better than nothing. When mathematical models fail, that is a place at which statistical model will come into play. See, for example, whether it will be raining today. All of you, can you tell whether it will be raining today in Chennai?
No, sir.
In the morning, it rained. Last night, the temperature went up like anything. So days where we were not using fan at all, yesterday, we could not have a normal sleep because we were thinking that it is going to be a cold night. It was not so. I was just looking into when there is no sleep coming up. I was just looking into my mobile. My dad was just shouting at me, "What is this you are doing? 10 to 5. You should not watch mobile at all." Say, which I normally tell to my children. Now my dad is just telling. So I just kept quiet. He started complaining to everybody. Murali is just using mobile all time. So where mathematically it is not proven, or it is not proven through mathematics that this is going to rain on a particular day, it will not rain. Or even if it rains, this is going to be this much of centimeters. No mathematical technique or tool will enable you to get any answer. So that is a place where statistical model will come into operation, where statistical model is not going to give you perfect answer, but it is going to give a suboptimal solution only. Optimal answer, you will never get it. So don't get the impression that simulation approach is going to give you perfect answer. No, the place where nothing is there, if somebody is telling that this model will be failing, something else only we have got to keep. No, see, if I have seen in a very recent function, some years back, the person was very lean and very sick looking, and people told that that person's two kidneys failed and she is undergoing dialysis. She could be in the age group of 40 to 45 with two children going to schools, with parents-in-law, parents, and all people there. She was sinking. She was sinking. Today, the same person we have seen in the function, I told that you are looking healthy now. I told voluntarily. She was very happy. I knew the fact that she got kidney transplantation from her mother. Now it is perfectly working. Mother is also okay. That girl is also okay. And she's just got regained that. But whatever it may be, she herself came. She was just telling, "Sir," she was my student. "Sir, I am just living on borrowed kidney from my mother. Thanks that you have given me a wish that you are, I am just looking healthy and all that, sir. That is the real boost. I will live for another 15 years if there is no other problem." So what God has provided, the original one, there is no substitute for that. But let her live for 100 years. No problem at all. Always remember, when anything foreign item is just there, the body will try to reject. Let that not happen to her. I'm just telling you that this is going to be a suboptimal solution, not like original. This is what? The glass. What I had as a vision before wearing the glass was superb. This is going to be a substitute. Likewise, only this simulation will give you suboptimal solution. It will never give optimal solution. So have that in your mind. So keeping a belief that this is perfect, I wanted to remove from your mind. No, it is going to give you only suboptimal solution. Have that in your mind. So I spent this amount of time only to drive home the point that it is not going to be a perfect solution. See, why I am just concentrating on this theory aspect is that questions are asked in this new syllabus, not problem solving alone. They are asking about the last part of the question. I do not know how many of you have watched this. Anybody have seen that institute's question papers or the way in which they have just asked? They are asking some theory along with the problem solving. How many of
Sir,
you watched that?
yes, sir. Actually, they don't ask the problems alone, sir. They ask problem, another problem, then they ask to compare which will be better. Like that only they ask the questions. Generally, in 8 marks, there will be 4 subdivisions in SFM.
So now you just see Venkatraj is just bringing out his analysis.
Sir,
So they
even in our
might
book
ask,
back questions there are there,
yes.
sir.
Huh?
Even in our book back questions, after the chapter questions,
Mm.
it's like they have asked two values to be identified, and the third question was how would standard deviation help in capital budgeting decision? Like a
Correct.
small 2 mark question, a 3 mark question, they're adding this.
So therefore, it is not simply you mug it up or do some jugglery and get the answer. You need to know why standard deviation is like that. I will just explain. Please just don't worry about that. There are 3 steps in simulation process: random number coding, fitting of random numbers, application in different business models to draw conclusion. So these are the 3 steps that you have. Random number coding, where you got to give class interval and all that. We will discuss that in greater detail a little later. Decision tree. Say this decision tree is one of the wonderful tools that you have. One of the wonderful tools that you have. So where all possible events are expected to be connected. So remember, I was just asking you the question. Year number 1, 3 cash flow. Year number 2, 3 cash flow. Year number 3, 3 cash flows. So how many combinations you can get? How many combinations you can get? Any idea? You got to arrive at for permutation and combination. My grandson, to him, he will be asking, Granddad, what is it you are studying? So just like that, I told permutation, combination topic I'm studying. Whenever I am sitting for studying, he is asking, Granddad, are you studying permutation, combination? So bring out that permutation and combination. That many. I don't want to dwell on that, though I just handled the class for CA Foundation on statistics. What is that we will be doing in the case of decision tree approach, where all possibilities we will be arriving at. A decision tree in a graphical representation of the sequence of action and event combination available to the decision maker. This approach ensures that all possible combination before a conclusion is drawn. This is a decision box, a small rectangle or a square type box. You call that as decision box. And this is event node. So any line drawn from a small circle, which will be an event. Any line drawn from a box will always be a decision box. Expected monetary value is the sum of the product of probabilities and financial values of various events. We will take up that a little later. I'm just only introducing about what and all we do have. The last one is real option. Generally, capital budgeting decisions are irreversible in nature. But there can be many practical alternatives possible. What are those? Considering those alternatives in the decision-making process is referred to as real-time option in capital budgeting. What are those? Abandonment option, delay in takeover, timing, then expansion option. These are the options that we have. We will just discuss all these aspects and we will take up one by one. Are you clear? Shall we proceed? Scenario analysis, where it is part and parcel of your sensitivity analysis, that we will take it up a little later. Correct? Certainty equivalent, coefficient of variation, scenario analysis and sensitivity analysis, simulation and real options. Okay. Now we will take up on to this illustration number 3. Yes, we will try all the problems that we have it in our institute material, whether it is illustration or into the book back. Can one of you just read out this illustration number 3? Please. Please read it out. Okay, you people are not interested in taking up illustration number 3. That is what I will understand. So I will call out 5 numbers, 1, 2, 3, 4, 5. Within that time, if you are not reading, then I'm skipping that question because I consider that you are not interested in take up.
Sir, I'll read, sir.
Yeah, you don't take permission at all. Read.
Possible net cash flows of project A and B at the end of first year and their possibilities are given below. Discount rate is 10% for both the projects. Initial investment is rupees 10,000. Calculate the expected net present value for each project. State which project is preferable. Possible event A, B. Project A, cash flow 8,000, probability 0.10. Possible event B, cash flow is 10,000 and probability is 0.2.
Okay.
For
So
project,
this way the probabilities are given. So now what is it we are expected to do? So now I'm just when it is a simple problem, I will just help you out as find out as how they are worked out. So this 8,000 multiplied by 0.1, the probability you are getting 800 as expected value. Sum of that you get expected net cash flow is 12,000, in this case 16,000. Okay. Now please understand the net present value for project A is going to be 0.909 into 12,000. Why 12,000? So you understand the subject matter that this is at the end of the first year. At the end of the first year would mean you have to take up the first year PV factor. First year PV factor. என்னாச்சு அதை போட்டு ஆன் பண்ணி பார்த்துக்கோ. So where you arrive at this number and you get 908 and in this particular case 4544. The net present value for project A and project B is arrived at in this fashion. So you would not have seen such a simple question, but if asked when we have not got the previous experience, we may not just know that it should be multiplied by 0.909 and we end up with some other number. So expected net present value multiple period. Are you understanding for the first part of the question, illustration number 3? For now, illustration number 4, where the probabilities for net cash flow for 3 years, they have provided you. So this sort of problems we have already done. So what is it? You find the cash flows are multiplied by probability and you are expected to arrive at the cash flows for each one of those years. Then what is it we are expected to do? These cash flows are to be multiplied by the respective years PV factor to arrive at discounted cash inflow. From there, 10,000 we have deducted, 2573 being the expected net cash flow. That is the NPV is what we will be arriving at. Remember that variance we have already done in the example that we have just taken up. So please understand the importance of variance and standard deviation, for which you can have a theory question. So go prepared for that. Huh? One moment. So then they are asking another question. Find out variance and standard deviation of project A. How do you arrive at this? You arrive at the expected value. Now this variance, how we have just done in that particular problem, same way you are expected to arrive at the variance and the standard deviation of these two projects. Are you clear? Say yes or no. Since we have already done a problem with the help of Excel, we don't have to spend time here. So it is a problem that you have got to take it up. So it is an assignment for you. Coefficient of variation, for which I have given you the formula and we have just done a problem. So here illustration number 6 is all about coefficient of variation. So that means you have got to arrive at the mean And then you got to arrive at the standard deviation of each, and you find the coefficient of variation. In the case of project A is 15.65 percentage, and in the case of B, which is 23.31 percentage. So because of the fact that it carries lesser percentage, risk is less when it is having a higher percentage. So risk level is more. So expected value is less and expected value is more. Correct? Are you understanding? So risk adjusted discount rate, we have already made a discussion.
Sir, once again, sir, coefficient of variation you told no, sir. Standard deviation by return. Coefficient of variation and correlation coefficient both are different.
Correlation is different.
Okay, sir.
Venkatesan is different. Venkatraj is different. That's
Okay,
it.
sir. Okay,
Just
sir.
because Venkat is coming, both are not same.
Okay, sir.
Coefficient of variation is different. Correlation is different.
Okay. Okay, sir.
Correct?
Okay,
Understood?
Sir. Okay, sir.
Coefficient of variation where you compare standard deviation and the mean.
Okay, sir.
Correlation is a reaction between two variables, whether
Okay.
they are positively correlated or negatively correlated.
Okay.
Say, in the case of coefficient of variation, it is for one project.
Okay.
Whereas correlation, when you say relation, would mean there is something else that you have.
Okay, sir.
Two factors are involved. Say, I will put it like this way. Say, Rajagopalan used to tell that there is one gentleman by name VV. He will always be exhibiting positive energy, is what he will be telling. That means whenever he is coming to the group, he is going to bring about positive vibe, +1, you can tell. And if somebody else is just coming, he will be telling, oh, what work that I have to do. I don't think so. I will clear the examination. Would mean, see, he is spreading what?
Negative.
Negative vibes. So you can understand what is the difference between coefficient of variation and correlation. Is that okay?
Yes, sir.
What is that we should be having? +1 is what we should be having. Perfect correlation. Wherever we just go, we have got to emit what vibe?
Positive
Vibe.
vibes.
Right. Risk adjusted discount we have already done. Now illustration number 7. Correct? Yes, one of you please read illustration number 7. One, two.
An enterprise is investing rupees 100 lakhs in a project. The risk-free rate of return is 7%. Risk premium expected by the management is 7%. The life of the project is 5 years. Following are the cash flows that are estimated over the life of the project. Year and cash flows rupees in lakhs. Calculate net present value of the project based on risk-free rate and also on the basis of risks adjusted discount rate.
Say the question itself, they have asked you find out the net present value based on risk-free rate. Risk-free rate is 7%. So you have year number 1, 2, 3, 4, and 5. Cash flows, whatever they have given, is going to be common for all. 25, 60, 75, 80, 65. Remember this? 25, 60, 75, 80, and 65. You have a PV factor with 7% arrive at discounted cash flow, arrive at by deducting cash outflow, arrive at NPV. Then another PV factor that you take it up with 14% and discounted cash flow. Where from I'm just getting 14%? So I have 7% as risk free. Risk premium is going to be 7. So 7 plus 7, 14% at which I am expected to arrive at the thing. That is what you have. So year number 1, 2, 3, 4 and cash flow is going to be common. So why should I waste that time and space there? So one I discounted at 7%, the other one I discounted at 14%, arrive at the net present value. Are you understanding? That's all you have. Then advantages of risk adjusted easy to understand. It incorporates risk premium in the discounting factor. Limitation, difficulty in finding out risk premium and risk adjusted discount rate. Though NPV can be calculated, but it is not possible to calculate standard deviation of a given project. So remember this point. There can always be a question. What are the disadvantages of RAD? Don't say it is difficult to understand. When you have an advantage as easy to understand, you don't say difficult to understand. When you are not studying, anything will be difficult. That cannot be a disadvantage implicit in the discussion. So always remember difficulty in finding risk premium. And it is not possible for you to find out standard deviation of a given project. So now certainty equivalent. Certainty equivalent, I've already communicated as what is that you are expected to do. So we will take up straight away on to illustration number 8. Now, one of you please just read out illustration number 8. I will start counting the number.
If investment proposal costs rupees 45 lakhs and risk-free rate is 5%, calculate net present value under certainty equivalent technique. Years expected cash flow certainty equivalent is given. First year 10 lakh cash flow certainty equivalent is 0.9. Second year 15 lakh cash flow certainty equivalent 0.85. Third year 20 lakhs cash flow 0.82 certainty equivalent. And last year 25 lakhs cash flow and certainty equivalent is 0.78.
Say now the cash flow is to be multiplied by certainty equivalent point. You will be getting a million with 0.9 is going to be 0.9 million. 1.5 million into 0.85, 2 million into 0.82, 2.5 million into 0.78. You will be getting a cash flow, the product of these two, which will be referred to as risk-free cash flow. When it is risk-free cash flow, then it should be discounted by 5% PV factor that you are just getting by deducting 4.5 million. What you end up is positive NPV. Therefore, you got to accept it. What are the advantages and disadvantages that you read and remember that not a big issue. Then you may be asked to write something about comparison between risk adjusted and certainty equivalent points. Okay. Are you understanding? Other techniques, sensitivity analysis, we have already done that. And illustration number 9. Vanessa, can you just confirm that whether this one was done before? Illustration number 9. I think we have
Yes,
just
sir,
done
it was done. It was done.
Right. So there is no meaning in redoing it. We have just done already. So advantages and disadvantages, whether you have 3 in numbers or 4 in numbers, at least what is there in the institute study material, you please check it out. Scenario analysis. So where you will be provided with a different sort of scenario, like worst scenario, most likely scenario, and best scenario. So we are expected to arrive at separately for worst, most likely, and best. Or it could be where you can say moderate. You can just have different sort of scenarios, and you are likely to end up with these numbers where you can say this is being the outflow, and you are taking up 9%. Let us just go through that. No big deal. Illustration number 10. Please just read out so that we will explain even scenario analysis also. Come on, please. Illustration number 10. Please read out. 1, 2.
XYZ Limited is considering a project A with an initial outlay of 14 lakhs and the possible 3 cash inflow attached with the project as follows. Particulars: worst case, most likely, best case. Assuming the cost of capital is 9%, determine NPV in each scenario. If XYZ Limited is certain about the most likely result in first 2 years but uncertain about the third year's cash flow, analyze what will be the NPV expecting worst scenario in the third year.
Right. So we are expected to arrive at the cash flows. As they have said, if XYZ Limited is certain about the most likely result in the first 2 years, most likely is what we are expected to take up. And in third year, worst scenario is what they are expecting. So 550 and 450 and 700. Take it up and you arrive at this. And independent of this particular statement, they are arriving at NPV for worst scenario, most likely scenario on that. So this is only a possible outcome that they are bringing out, but here they have given an instruction as how you got to approach this subject. So you are ending up with, for such an expectation, a positive NPV of 23,871, and that is the basis on which you say you got to accept or to reject. So the next theory portion is a comparison between scenario analysis and sensitivity analysis. So please just keep your thing. I think Venkatraj, you can just put it in mute mode, please. Please put it on mute mode. Right. See, every time you should not be just keeping on reminding to you, we are all very well behaved and good students. Okay. So next one, simulation analysis, Monte Carlo simulation. Already I've just given this adequate amount of introduction, and we are expected to arrive at the simulation with the help of computer generated random numbers. Okay. So a human being generating that will not be giving you a appropriate solution. Okay. Now, there is only example that they given, no illustration that they have provided. So they have went on to explain. Decision tree analysis. Say, I will provide you a separate material for advanced capital budgeting. So therefore, it is better that you use that, and I will provide you separately for Monte Carlo simulation. And I will explain to you through those problems. Okay. Now, we will try illustration number line for decision tree. Even for decision tree, I'm just feeling like that I will provide you replacement decision. That also we have just done, EAC, EAB, optimum replacement cycle and all that we have just done. Okay. Now, I will take up questions from our material. So I would like to concentrate on this expected NPV, variance, standard deviation, coefficient of variation with one more problem. Illustration question number 16 that you find it in the screen. Shall we do it now? Please. One of you, please just read it out. So I will just take up F out from our discussion, or I will say A, B, C, D alone. Up to that, we will take it up. E and F, we will not be in a position to do it today. Come on, please read out question number 16.
Sir, an investment proposal has the following probability distribution of returns. Year 1, year 2, year 3. Year 1, 6,000, 8,000, 9,000. Probability 0.2, 0.4, 0.4. Year 2, return 8,000, 12,000. Probability 0.5, 0.5. Year 3, return 7,000, 11,000, 17,000.
One moment. Okay, please read it out. Please read it out.
Year 3, return probability, return 7,000, 11,000, 17,000, probability 0.3, 0.5, 0.2. The events of each year independent of other years. The outlay of project is fixed at 22,000 and the appropriate discount rate figure is 10%. Find the following: expected NPV, variance of return, standard deviation of NPV, coefficient of variation, probability that the project yields less than 10%, probability that NPV is negative using value of A and C, and on the assumption normality of the distribution of NPV, compare the result with that of E.
Okay, that I told you E and F not required, but anyway, I did not stop you from doing it. Okay. How is that we will try this? How is that we will try? We have just done that problem. No. So that way we will take it up and did I give you this material to you? Did I share this to you?
But not in this group, sir, for old video chats.
I think we have just done that before. So can one of you take the screenshot and help me out when we are drawing it out? Vanessa, could you do? Pavan, could you do this? Keep that.
Yes, sir.
Right. Cash flow. Please let me know the cash flows.
Yes, sir. Year
Year
one,
number one.
6,000, 8,000, 9,000.
Probability.
0.2, 0.4, 0.4.
Expected cash flow. Variance. Come on, you please let me know how the variance is to be computed. One of you please give me the direction. Imagine that I have forgotten.
Probability into 6,000 minus 8,000 the whole square.
How do we arrive at standard deviation?
Square root of variance.
Correct. Yes.
Cash flows are 8,000 and 12,000. 0.
Probability.
0.5, 0.5. Last is 0, sir. 0 per.
Probability into 8,000 minus 10,000 here. Is that right? Year number 3. What are the cash flows that you have?
7,000, 11,000, 17,000.
Probability.
0.3, 0.5, 0.2.
This is probability into 7,000 minus 11,000 to the power 2. Correct. Okay. Then year number 1 to 3. Their cash flows are 8,000, 10,000, and lastly 11,000. Correct? What is the PV factor percentage? 1 divided by what is the percentage? 1.1.
10%.
10%. 1.1 to the power of this discounted cash flow. Discounted cash outflow is 22,000. NPV is 1,801. So then standard deviation and variance. What is the standard deviation? Standard deviation is 1095, 2000, 3464. Variance is standard deviation multiplied by PV factor to the whole power 2. So standard deviation is this. Is that okay? All of you say yes or no. Are you clear? So now look into the question. Expected NPV, variance of return in each of the years, standard deviation, coefficient of variation. What is the coefficient of variation? COV is equal to standard deviation divided by mean. COV is equal to standard deviation is 3240 divided by mean 1801. Correct? Are you clear? Say yes or no. Are you clear about this?
Yes, sir.
Now, we have just set one method of work and we are just confirming it. Are you noting down? Make a quick screenshot so that at a later stage you work out of your own and be ready with that. Have you got it?
Yes, sir.
Yes, sir.
Now, I would like to do this like a layman. Layman's approach is the best approach. Anybody can link themselves like this way. Combination, I will work out with different combination. 1, 2 and all that. Here, I will work out as year number 1, year number 2, year number 3. In year number 1, what and all combination I can have? So come on, tell me. and I can arrive at NPV like this, and this being 0.9091, 0.8264, 0.7513. So what is the cash flow for year number 1 and what is the cash flow for year number 2? Come on. Pavan ji,
Yes, sir. 6,000.
you got the screenshot. No, from here you got to put 6,000. Year number 2.
8,000. Sorry, year number 2 is 8,000.
Year number 3.
7,000.
7,000. How do you arrive at NPV? Tell.
We have the discounting rate now, sir. So multiply by it and less cash outflow.
See, when you have Excel, what is that you feel like that we should do?
Equal to
In that is, we got to draw like that and finish it off just like that. Wink of the eye, you should be getting the answer. Come on, tell me, how do you do that? Next one. Can you tell me what is the next one?
8,000.
I will take up 6,000 and year number 2.
12,000.
12,000 or 8,000. 8,000 and it is 12,000. Am I right?
11,000, sir. Year number 3, the second thing.
Are you understanding? Sorry, last one is 7,000. Huh?
7,000.
No. Last one is 11,000. Sorry. 11,000. Am I right?
Yes, sir. That is, sir. Year 1 and year 2 remains the same cash flow. Year 3 alone change.
So 7, 11 and what? 17. Correct? Correct? 7,
Yes,
11 and 17 I'm going to have. Correct? Here I have what? 8,000 and 12,000. Is that right? Am I just doing it right? Please just help me out.
Sir, I think one should be 0, sir, other than 8,000, 12,000,
Huh?
0. 8,000, 12,000 and 0. No, so we should also consider 0. No, sir.
I didn't get you. Can you just come again?
That is 8,000, 12,000 and nil. No, sir. We should also consider that 0. No, sir.
No, 0 is not there in the scenario. So I have just taken 0 in my computational convenience. That's it.
Oh, okay.
That slot, I just don't want to use it. It's not there at all. It is not an event at all. So 8,000 and 12,000 that you have. Tell. I am exhausting all possibilities. See, am I exhausting all possibilities is what I'm just asking. Come on. I'm taking 12,000. 12,000. In all these cases, I am taking what? 6,000. Am I right? This is one combination I've just brought.
Yes, sir.
Is that right?
Yes, sir.
Now, what is that I should do here?
6,000 will change, sir. It will become 8,000 now. 6,000
Six
will become 8,000.
will become 8,000. Correct?
Yes, sir.
Then,
Then again, instead of 8,000, 9,000 will be there.
are you understanding?
Yes, sir.
All of you, are you following? All of you, please just help me out. Are you following or simply a spectator there? Then I'm going to give you a top class
Understood.
secret, my dear. Yes.
Sir, could you explain it, sir, again?
So I have before me 3. 3
Okay,
cash
sir.
flows in year number 1 and 2 in second year, 3 in the
Okay.
third year. So
Okay.
3 into 2 into 3. How many combinations possible? 18 combinations possible.
Okay, sir.
I am exhausting all the possibilities now. Am I right?
Okay.
Are you understanding? Keeping this 6,000 for first 3, 8,000 for the next, sorry, keeping the 6,000 for 6, 8,000 for 6, another 9,000 for 6. I am just making the changes this way. Are you understanding this combination? Now, how I am arriving at NPV, all of you closely follow. This is an Excel formula I am just using. All of you closely follow. Some product, what is that? This is going to be constant for all, isn't it? Comma, this minus 22,000. What is 22,000? So please just please put it in mute mode. You are disturbing me. I do not know who is just doing that. So some product, that is PV factor multiplied by the cash flow minus 22,000 is giving me what? NPV, where I don't want 0 into it. I mean, I don't want any approximate number. I am having this being the NPV. So probability I will arrive at. What is the probability corresponding to 6,000, 8,000 and 7,000? I got to multiply. What and all I should multiply? All of you, 20%, 50% and 30%. How much it comes to? 0.2 into 0.5 into 0.3. How much is that?
0.03.
0.03. What is that? What are the numbers that we are going to take up? 0.2 into 0.5 into 0.3. Am I right?
Yes, sir.
Next one. Tell me, what is the next one that you people need to do? Which combination we are having? 0.2 and 0.5 remaining the same. Here it is 0.5.
0.5.
So answer is 0.05. Am I right?
Yes, sir.
Next one, 0.02. Is that right?
Yes, sir.
All of you. Next one.
It will be the same, sir, because 8,000 and 12,000 have same probability.
Next.
Next is 0.4 into 0.5 into 0.3.
So with 8,000 coming up there, the corresponding for 8,000 is 0.4. So it is double the size. Correct?
Yes, sir. 0.06.
Into 2. This I will drag up to 12. Correct?
Yes, sir.
And
Again 0.4 only, sir. So the same can be used.
if I sum up, what should I get? 1 I
One.
should get. Am I right? All of you, are you following? Expected NPV. What is expected NPV? NPV into probability, where I just don't want any decimal. I'm just rounding it off. I just get 1801. Where is it? We are getting 1801. Remember, I'm just getting 1801. Are you understanding? All of you, say yes or no.
Yes, sir.
We don't have the luxury of doing this under Excel, but we have all that in this world to understand with the help of Excel in a classroom, so that we are very strong in our basics. Correct? Yes or no?
Sir, could you explain the NPV again, sir, one more time?
say NPV, are you talking about expected NPV or NPV?
NPV, sir.
Say, are you in the habit of using Excel in office or no use you are having for Excel?
Sometimes we use, sir, in office.
You have to use heavily. Only then you will understand it. So it is something very simple only. 6,000 into 0.9091 plus 0.8264 plus 7,000 into 0.7513. So better you put it in mute mode, Venkatraj. So always the disturbance is spoiling my flow. 22,000. So this is the first year. This is the second year PV factor and this is the third year PV factor. And minus 22,000 is giving me the NPV of 4675 negative. This is for combination 1. This way 18 combination I got to work. Different possibility of having different combination of having my net present value. But that is when I take up the project, I will end up with either negative 4675 to I have 8871. One of these 18 items I will definitely be hitting. Am I right? Are you understanding, Venkatraj?
Yes, sir. Yes, sir. Understanding.
Shall I proceed to the next stage? See now, why it is called as mean is because of this. Because it takes care of all the possibilities of the net present value multiplied by the probability, you are getting that mean. Now, I got to bring out variance. How do I arrive at the variance? Come on, equal to. Remember as how we have just done that. You have multiplied by probability into this is the NPV minus 1801 to the power 2 to the power 2. Is that right? All of you say yes or no. Then I drag this and bring out the total. Standard deviation is equal to square root of the previous number 3240. Remember 32398956. I'm just getting that small difference because of the approximation that we have made. Are you clear? Say yes or no.
Yes, sir.
So
Yes, sir.
whatever we were doing here, these are all, I would consider them as black box approach. What do you mean by black box approach? I hope that all of you be knowing something about audit. What do you mean by black box approach?
Sir, black box approach means like you're doing it on the on a physical basis. You're counting individually and you're putting the values, applying mathematical formulas like that.
I will not reject as wrong, but at the same time, I'm not in a position to accept as right. What do you mean by black box approach? Pavanji, Vanessa, Ramakrishnan, Shivagama Sundari, Ramakrishnan. Ramakrishnan, are you there?
Yes, I'm there.
Yeah. What do you understand from black box approach? Shivagama Sundari, what do you mean by black box approach? Now I'll tell you. So you people are unwilling to share your knowledge. You're all epitome or lighthouse of knowledge. It is only the time that will tell you that you are a chartered accountant or not. I see that all of you are becoming chartered accountants very soon. But you need to share your knowledge. Even if you are not having any idea, please just explore. Now I'll tell you what is black box approach. Black box approach is something like where I know the test result as output. I put in something into the system. I know what is the result. What is happening in between regarding the process, I do not know. That is the reason as why you call this as what? Black box approach. I do not know what is the process. How it is happening, I do not know. It is something like I am putting some quantity of water, some rice, and putting it into the cooker. How it cooks, I do not know. I do not know the process, but I know the result. I know the input, I know the result. What is that that goes in between, I do not know. Since I do not know what is happening in between, you call that as black box. Whereas this sheet, what you find here is not black box. I am telling you every item of input, right from the first item of 6,000, second year 8,000, 7,000, how it is bringing you net present value. I am just telling you. I have asked you at the very initial stage how many combinations possible. Did I not tell you that? You people are keeping quiet. 3 into 2 into 3. What is 3?
3 cash flow possibilities for
3
year 1.
cash flow for the first year. 2 in the second year. 3 in the third year. So, if I am just giving the project to all whom I know, all these people who will carry out this project will get 1 out of 18. 1 out of 18 they will be getting, and they will be experiencing any one of these NPVs, and their probability of their occurrence will be this much. On an average, I will arrive at taking into consideration all that 1801, and therefore the standard deviation is this, and this being the mean. Are you understanding? You should never feel like this standard deviation, variance, mean as Greek and Latin. You should not be just thinking like that. From now on, you should know us how to arrive at mean, variance, and standard deviation. Are you clear? That's my objective. So coefficient of variation, all that we have just done. Are you understanding, all of you? So if you are given with a problem like this, you should be in a position to crack it. You know the logic, you know even the black box, whichever way you feel like that you are comfortable, you can do it. So in our practice, when we are doing, it is better that we do it in a detailed fashion. There is no time pressure that we have, but same time, you should know how to play ODI and T20 even in test match. So therefore, you need to know how to save time. Are you clear? Say yes or no?
Yes, sir.
Probability that it will result in less than 10% and all that, we will take it up in the next class. Now, there is something called as conditional probability. So the one that you've just seen in problem number 16 is not with conditional probability. What do you mean by conditional probability? Any idea about what you understand from the term called as conditional probability?
Sir, whether to use the probability or not itself will be dependent on the condition.
What do you mean by that? Can you elaborate? Can you just give detailed discussion on that?
That is on a particular condition being satisfied only, that event will be probable.
Say that sort of problems with conditional probability, you got to do it through decision tree model. The problem that we have just handled, there is no condition that they have provided that if 6,000 were to happen in year number 1, in year number 2, it is going to be 12,000. There is no precondition that they have fixed. Correct? Preconditions will happen like this way. So parents, when they are expecting baby, they will have the names of the baby in their mind. If it were to be a male baby, a name will be different. If it were to be a female baby, a different name. So based on that condition alone, they will fix it up. Whether they will be buying a frock or whether they will be buying for boy baby will be dependent on what is happening in the very first place. Right? So we understand that way in year number 1, in the next problem, if it were to be 25,000, in year number 2, it could either be 12,000 or 16,000 or 22,000. If year number 1 inflow were to be 30,000, then in year number 2 is going to be either 20 or 25 or 30. So when you have that precondition as what is likely to happen in year number 1 and what is likely to happen based on that in year number 2, you call that scenario as conditional probabilities, and conditional probability problems are to be handled only through decision tree. So imagine that 18 combination, can you just draw 18 combination? Humanly, under examination conditions, not possible, but I've just done it with the help of Excel. Are you understanding what I'm telling? So extension of this probability in decision tree model, we will take it up in the next class. So at this moment, I feel that we have just done RAD approach, certainty equivalent approach, coefficient of variation. We have just done mean, standard deviation, and variance, and application of normal distribution. And we have just done sensitivity analysis in one of the earlier classes. Scenario analysis also we have just done. So now I can tell for sure that what we have just done through today's class were all risk adjusted discount approach we have done. This we have done certainty equivalent, coefficient of variation, scenario analysis, sensitivity analysis in earlier class. We have not done anything on simulation. We have not done anything on real option. So statistical tools we have used heavily in today's class. So 2 hours of class enabled us to proceed and understand all these. Almost we have run through the entire advanced capital budgeting, and what is kept pending for the next week could be these practical questions. So here is a place where Pawan was just telling how would standard deviation of the present value distribution help in capital budgeting. So you can consider how standard deviation is going to help. Risk analysis, that is measurement of risk is coming through standard deviation, and we can try the application of coefficient of variation. So only when you try doing a lot of problems, you will be in a position to handle this. So only in few such problems that they have just given that. But anyway, it is a good combination of questions or good collection of questions that they have provided. And I will also be sending you in today's, that is through WhatsApp, this PDF, so that you can come prepared for the next class. And if time is there, we can have in one of those days evening class, see after 8, we can have 8 to 10 or something like that. Can finish off advanced capital budgeting, all the problems. So you will not just leave any problem there. So you have how many problems? 27 problems. All the 27 problems we will solve. But we need to have some extra classes in the evening. So for that, 8 to 10 would be an ideal thing. Maybe not daily we can have it. And I will let you know because I have other classes also. So keeping that in my mind, I will take your consent and then we will fix it up. Is that okay? Shall we just close for this Sunday?
Sir,
If
we'll
you have
also
any
do,
doubt, you can just ask.
sir, we'll also do the illustration 11, 12 next class, sir.
Illustration?
11, 12 decision tree analysis.
See, I told you that decision tree I got to handle.
Okay, sir.
So conditional probability with which I am telling you decision tree can be handled only with conditional probability. Have
Okay,
that in your mind. See,
okay, sir.
Venkatraj, don't have any sort of feeling that I'm going to skip that.
Okay, sir. Okay, sir.
I will sit pretty. I will just thank Almighty to give all that energy to solve all the problems,
Okay,
illustration and book back and all that. You don't have an doubt in your mind that
okay, sir.
one problem I will skip and that I will just run away from that. Please just don't have that feeling.
Okay, sir. Okay, sir. Okay,
You will sit pretty and I will be asking many times such questions, whether you have understood or not.
okay,
Please
sir.
just don't worry. Enough amount of time God will give and we will
Sir,
do that.
sir,
Yes.
now understood,
You
sir.
are the only anxious person in the class. Don't worry about that. Your sir
Okay, sir.
will not leave just like that. Come on.
Okay, sir. Understood, sir. Capital budgeting, because the portfolio also I saw your videos, sir. There is script and all. You thought this. That's why the application is now more easy and able to understand it more faster.
And don't tell this to me. Tell to all your friends. Okay. So
Okay,
I
sir.
know what I've just done. So doing Archana and Puja and all that I don't like. Okay. So
Okay,
you
sir.
do that and bring lot of students for me. Okay.
Okay,
That
sir.
is better.
Thank you, sir.
Okay.
Okay, sir.
So telling that a class is very good, nice, sir, and all that. I know.
Okay,
Correct.
sir. Okay, sir.
I don't want any puja, archana, and aradhana and all that. All that my ma'am is doing. My parents are doing. Children are doing. Okay. That archana and puja and all that, I have just become, it is too cold for me. Okay.
Okay, sir.
So you enjoy your class and doubt, if any, you please raise. And if you feel that you are excited, you tell your friends. Okay. I'm not just telling you should bring. If you feel excited, you feel that some that is worth time spending, you tell your friends. Okay. Thank you. And we'll be meeting. If you have any doubt, you can just ask. We have 1 more minute. Okay. We'll meet in the next. Thank you.